Before we turn over to questions and answers, I was going to get my business partner, Rati Lahur, who organises my website and makes events like this possible, just to say a little bit more about what we can expect from this site in 2021. Rati, over to you.
Good morning, everyone. Thank you, Saul. Hello, everyone, from a very cold, snowy morning in the Black Forest, Germany. I'm Rati Luhur. For those who doesn't know me, I have been working on Saul's website for many years. And recently, we've been working on building his online community and make his work more available to the world. Since we are only a small team of 2, you will be seeing more of me as we continue to explore better way to engage with you. Saul's next presentation is going to be on the 2nd of February. We hope that we can see you then. You can sign up on the website, or you can also join our premium access package, which allow you to access the presentation for free. So everything is included in the premium access package. And for today, we have a special. If you join within the next 2 days, we will give you 1 month extension to your membership if you join the annual membership. And I will hand over back to Saul for question and answer, as I know that we've gone already over time, but I look forward to see you all. And if you have any questions, suggestion, ideas, please feel free to write to me through the website. Thank you.
Thanks, Rati. Now we've got a little bit of time for questions, and I do have one from Melody Lee. Thank you, Melody, for putting that. She asks, do I think Australia will see a housing bubble next year? And she notes that the Australian government, like many other countries, has been injecting a lot of money to the public. Will there be any side effects? As a general proposition, Melody, quantitative easing, that is government purchasing bonds and creating money in order to do it, does have an impact on the price of all assets. It will put asset prices up, not least because the people who sell the bonds to the Reserve Bank will receive cash from the Reserve Bank, and they will most likely put it to use at some point, even if initially they keep it in the form of bank deposits. And indeed, as central bankers since Ben Bernanke have been saying, that's one of the ways in which quantitative easing is meant to work. It's meant to work by prompting people to move out along the risk curve, pushing up the price of riskier assets, whether it's corporate bonds or commodities or shares or real estate. And so in Australia, that's going to have some spillover effects into real estate, as will all of the specific measures that the federal and state governments are undertaking, in particular by providing cash assistance to first home buyers. Western Australia and South Australia have been particularly generous in that regard, and I think that you can, through federal and state government schemes, receive in excess of 40,000 Australian dollars if you're an eligible first home buyer looking to buy a new home in Western Australia, and close to that in South Australia. But all states have schemes of this sort operating at the moment. And the likelihood is that they will have some pressure, some upward pressure on house prices. But I think it's unlikely that we will see a return to the bubble that many people thought was a fair description to apply to the Australian housing market between the mid-1990s and 2018, when our market peaked. And there are a couple of reasons for saying that. One is that we're not going to see the demand from migrants, at least for the next 2 years, that we had done over the previous 20 years. You know, the migration intake will be zero until the middle of 2022, and I think it will recover only gradually after that. The second thing is that we're not going to see the same degree of demand from investors as we had done for much of the period from the early 90s until 2017, and in particular after 1999, when the then Howard government made the capital gains tax regime much more favourable to property investors than it had been. People who know me well will know that I've long opposed the option that's called negative gearing in Australia. That is the provision whereby you borrow so much to purchase an investment property that you spend more on interest than you receive in net rent, but you can offset that loss against your other taxable income and hence reduce the amount of tax you pay, while you sell the property at a profit. That's a capital gain, and so you only pay tax on it at half the rate that you'd pay on ordinary income. The thing is, it's now much more difficult to arrange to be negatively geared because interest rates are so low. And so it's not going to be as attractive an investment strategy for investors as it had been. And also because property prices are now much higher than they had been for most of the previous 20 years, investors are just simply a bit more nervous than they had been about expectations of future capital gains. So I don't think we'll see the same pressure from domestic investors, and nor, of course, will we see much from foreign investors either, partly because the federal and state governments have imposed taxes on foreign investors in real estate, which had already driven them away significantly before the pandemic hit. But also importantly, the capital controls which the Chinese government imposed in about 2015, 2016 to stem what was a significant depreciation of the renminbi at that time, that's also curtailed what had been a significant source of foreign investment into Australian residential real estate up to that point. And I don't think the Chinese will be relaxing their foreign investment restrictions anymore. And probably, given the political relationship, the Chinese government would take a dim view of any investment in this part of the world, since we're persona non grata with Beijing for the time being. So for all of those reasons, Melody, I don't think we will see a return to the bubble, and I really hope we don't. I mean, if it looks as though we did, I would hope that the federal government would start ratcheting down the assistance they're providing to first-home buyers and contemplating other measures, or of course the Reserve Bank might contemplate increasing interest rates a bit in order to deflect that if it were to become a serious financial stability issue. But for time being, I think the economy is better off with very modest increases in house prices that we're seeing, rather than the alternative that had worried people more, which was price declines of 10%, 20%. Some people were even talking as much as 40% as worst case scenarios. And thankfully, we haven't seen any of those. So I hope that's answered that question. Let me just see if there's any more that's come there. Someone has asked, this is Vikram Baranadaraji, I probably mispronounced your name, I apologize for that, asking what QE is. QE is quantitative easing, it's called. That's a term that I think was invented by the Bank of Japan when they first embarked on this course in the early 2000s, and then it was embraced by Ben Bernanke as head of the Federal Reserve. What it means is trying to ease monetary policy by means other than adjusting prices of money, that is interest rates, instead trying directly to expand the quantity or volume of money. That's why it's called quantitative easing. And what the Reserve Bank, what other central banks do, is typically purchase government bonds, not directly from the government, because that is very close to, if not exactly replicating, the kind of monetary financing that, as I mentioned before, was notoriously associated with Weimar Germany in 1923, or with banana republics like Venezuela and Zimbabwe in more recent eras. And that really does blur the distinction between fiscal and monetary policy to what most people would regard as an unacceptable degree, unless you're an advocate of modern monetary theory. And that's something we might use as a topic for a separate seminar or webinar, rather than going into that now. So central banks will buy government bonds from other holders of existing government bonds, pension funds, banks, foreign investors, private investors, and in that way seek to inject money into the economy, which, as I mentioned before in answer to Melody's question, the expectation is that those who sell the bonds to the central bank would then use the proceeds to buy some other asset and push up its price. In some cases, particularly in the United States and Japan, the central banks have bought corporate bonds, or in Japan, they've actually bought corporate equities as well, or ETFs with equities in them. Another form of quantitative easing that central banks, including now the Reserve Bank of Australia, the RBNZ, the Bank of England, the European Central Bank, and the Fed, have done is by doing direct lending themselves, either to banks, who in turn lend to customers. The Reserve Banks set up a term financing facility to provide finance initially at 0.25% per annum. More recently, that rate's come down to 0.1% per annum, to lend money to banks on the condition that they in turn lend it out to businesses. The Federal Reserve has directly lent to local governments and to employers to help small businesses meet paycheck obligations and so forth. So that's another different type of quantitative easing that central banks have been able to pursue. To be fair, Neither central bankers themselves nor academic economists are completely confident that they know all of the ways in which quantitative easing works. And you sort of have to ask yourself what might have happened if central banks hadn't done quantitative easing. During the financial crisis, certainly in the United States, if the Fed hadn't bought large quantities of treasury bonds and large quantities of mortgage-backed securities, then there almost certainly would have been a blowout in the mortgage rate in the US, which is a fixed rate, unlike Australia or the United Kingdom. And so that aspect of quantitative easing during the financial crisis certainly helped prevent the housing bust in the United States from being worse than it otherwise would have been. Another important motive for the Reserve Bank of Australia has been to reduce some of the upward pressure on the exchange rate, because it now seems to be fairly well understood that when the US or the Bank of Japan or the European Central Bank buy large quantities of bonds and create money in order to do it, the money they create, all else being equal, puts downward pressure on their exchange rates. And so, for example, the Fed's quantitative easing is thought to have resulted in the US dollar being weaker than it otherwise would have been. If the Australian Reserve Bank doesn't do the same thing, then the Australian dollar would be higher than otherwise, partly because yields on Australian government bonds would be higher than otherwise, and that would attract capital into Australia from foreign investors, putting upward pressure on the exchange rate. The Reserve Bank has been quite explicit in saying that their $100 billion bond purchase program that they launched at the beginning of November is designed, among other things, to ameliorate that source of upward pressure on the exchange rate. Now, some people would look at what the Australian dollar has done since the Reserve Bank launched that program, going up from about 70 US cents to over 75 US cents, and concluded that the Reserve Bank has failed. The Reserve Bank's answer would be, as the Governor Phil Lowe has said a couple of times, is that the Australian dollar would probably be even higher than it currently is had they not undertaken the bond purchases which they have done. That's why, as I say, if they think they need to do more of it for that reason, they probably will. So I hope that's given some insight into what quantitative easing is. I'm not sure whether there are any other questions there. I'll just check on the, there aren't any posted in the website. Oh, here's another one there. Leanne McGee, do I care to make any presentations about the predictions about the university sector? Well, you note in the question there, Leanne, and I think that's important, potentially a big reduction in Chinese students. At the moment, the reason that there aren't any students here, or there aren't nearly as many students here from China or any other country, is, of course, that Australia won't let them in. It's not that foreigners aren't sending them there. It's that Australia won't let them in. But the expectation is that we will gradually open our borders to international students who, after all, are very important to our university sector, and international education has been Australia's fourth biggest export revenue earner in recent years after iron ore, coal and LNG. So it is an important consideration. I think the reality is that we will not see large numbers of Chinese students either returning here or coming here to begin their studies even after the borders open. Chinese officials had been saying, I think as early as August, that they would be telling their people that Australia was not a safe place for students to come. That's nonsense, of course. Just because a Chinese government official says it doesn't mean it's true, and it clearly isn't. But the Chinese people aren't allowed to check for themselves what's happening in Australia because the Chinese government censors the internet so that they can't, for example, do a Google search. And in any case, even if they could, I think if a Chinese family were to defy the wishes of the Chinese government and send their children to study in Australia, if the Chinese government tells them not to, then they would probably face some very unpleasant consequences. Don't have to go into detail about all of that. I think we all know what we mean by saying that. So that's a serious problem. Now, most of the Australian universities have to different degrees recognised that they had become perhaps more dependent on China as a single source of students than was desirable from a risk management point of view. And so they have been trying to diversify, especially to India, but also to other countries like Nepal. Is surprising for a relatively small country to be the third biggest source of international students at universities in Australia today. other educational institutions have been looking not only to other countries in Asia, but also to, for example, Colombia and Brazil as significant sources of students, not all of them for tertiary education, but for other vocational courses, English as a second language, those sorts of things. But I think the universities just do need to work hard to source students from other parts of the world to the extent that they can. Of course, one of the other difficulties that universities face at the moment is simply that the government doesn't like them very much. You know, it's interesting that apart from the major banks, who the government doesn't like, or at least the government thinks there are votes in not liking them, the universities were the only sector of the economy who were deemed ineligible for JobKeeper, even though their turnovers had fallen a lot because of the absence of international students. And the government's put through various other changes that express its dislike for the fact that universities train lawyers and arts graduates and so forth. So yeah, they're not dealing with a particularly friendly environment as far as public policy making is concerned. And that's going to be difficult for vice chancellors and university administrators more generally. I think conditions will be tough for universities at a time when we really need universities to be at their best because of the imperative of improving productivity and the quality of human capital. It's not the first time that government policy doesn't always seem to make sense to an objective observer. It's probably about as much as I can say to that, Leanne. I hope it's of some help. Any other questions?
Yes, there are 4 other questions in the Q&A, Saul.
Okay, okay, yes, and many of Australia's drags on Australia's performance are also relevant to New Zealand. Yes, that's absolutely right. New Zealand and Australia are very similar. New Zealand has had better results, I suppose, in managing the virus than Australia has, but they've had a more severe lockdown and a bigger contraction in economic activity than Australia has had. So I guess how you assess the two countries from that perspective is to some extent in the eye of the beholder. New Zealand, of course, doesn't have anything like the resource base that Australia has. So they haven't, for example, benefited from strong demand for iron ore, or up until recently from demand for LNG and other minerals. Rather, New Zealand's prosperity has been based on exports, particularly of dairy products and to a lesser extent seafood, lumber products and things like that. New Zealand isn't in the doghouse with China in the way that Australia is. So from that point of view, they have less downside. Their government is, if anything, doing more fiscal stimulus than the Australian government has been doing, and that in turn has been quite a lot. Although New Zealand today released its mid-year economic and fiscal outlook, and they are now talking about large but nonetheless smaller budget deficits and smaller increases in public debt than they had foreshadowed either just before the last election or in their budget that they brought down in May. New Zealand is also much more dependent on migration than Australia has been. So they have some important challenges in determining when to open their borders to international migrants as well. But in other respects, I think New Zealand is as well placed as Australia, possibly even a bit better because they don't have the problems with China that we do to navigate its way into the post-COVID world. Now I see there's another question here from Preston Samasurisos. Again, apologies if I've mispronounced that. Do I have a view on whether a permanent increase in job seeker is warranted and its stimulatory effect relative to other stimulus measures? Yeah, Preston, my view on that is that there should be a permanent increase in job seeker. It's been left at $40 a day equivalent for way too long. You go back to the early 90s when government started getting nasty to the long-term unemployed, and job seeker, or New Start as it was then called, was equivalent to about 90% of the age pension. Now it's down to about 60% of the age pension. It doesn't need to be that low to give people an incentive to go and look for work. Most people are unemployed, don't choose to be unemployed. It's not nice living on that sort of income. And I think, my view is that job seeker ought to be set at a fixed percentage of the old age pension, so 80% of it, 85%, and then that problem goes away. And just as the pension gets indexed every 6 months, then automatically the job seeker payment would go the same way. And the other point to make about it, which is implicit in your question, is that because this is a payment to people on low incomes, almost all of it's going to be spent. It's each dollar that's spent by the government in increasing or making cash payments to people on low incomes is far more likely to find its way in full into the economy than a dollar that's given by way of tax cuts to someone on an income of over $100,000 a year. So not only would it be, I think, socially just to have a permanent increase in New Start, but I think it would also be a more effective form of stimulus. Now I'm just looking here at a couple of other questions that have come up. One from Joseph Roach. Hello, Joseph. Thank you for being here. The inflation outlook has me perplexed. The volume of money has increased enormously. The goods and services, not so much. Are the monetary theories of the 70s and 80s dead and repudiated? Yeah, that's the sort of Friedmanite theory. I think the answer to that is that those monetary theories that Friedman in particular did so much to advocate were theories that were applicable to a closed economy. And the US was almost always a more closed economy in the sense that exports and imports as a proportion of GDP were much smaller than they were for more open economies. And now, as a result of globalization in particular, inflationary trends in a much broader range of countries have an influence on what happens to inflation in any single country. Indeed, now it's almost a consensus opinion among economists that inflation is determined globally rather than locally or nationally, as it used to be when these theories were first promulgated. And the other point to make, I suppose, is that the money that's being created now isn't really being used to purchase goods and services as the money being created in the 60s and 70s was. Rather, it's being used to purchase financial assets and real assets. And as I mentioned before, the prices of those assets is going up. We're seeing financial asset inflation. We're seeing asset price inflation, which, and I know you'll have views on this, Joseph, have implications for the distribution of wealth between those who own assets and those who don't. But it doesn't necessarily cause price inflation unless that increase in wealth prompts increases in spending on goods and services that exceed the capacity of the economy, including through imports, to supply them. And I don't think that that is happening. Jared asks a question about the Australian manufacturing industry and if I think specific industries will prosper. In a sense, that plays into the argument that's been put that manufacturing is likely to provide one of the major supports for pulling Australia out of the recession that we've been in. There are undoubtedly some areas of manufacturing where that's true, and I'd specifically identify greater processing of our food and beverage, our raw or primary food and beverages, and to some extent our mineral resources, as long as we can get a coherent energy policy that's consistent with our emission reduction targets, which I, for one, think ought to be more demanding and ambitious than they currently are. We ought to be able to produce bigger volumes of renewable energy than we currently do. And if we could do that, then we could certainly do more processing of metals like aluminium and zinc than, or for that matter, manufacturing steel than we do at the moment. But we can't do that in a sustainable way if we can't significantly decarbonize our energy and electricity production sector and become more reliant on reliable renewables, which again, as I say, requires changes in energy policy that I don't think we're going to get from the current government. But more broadly than that, I think I have to make the point, and I know some people will disagree with this, that Australia simply isn't well placed to be competitive on a broad scale in manufacturing. And that's because experience shows that to be competitive globally in manufacturing, you need scale in order to reduce the fixed costs that are a bigger part of manufacturing's cost base than they are of most services industries, to levels that allow the prices manufacturers have to charge to cover their fixed as well as variable costs to be consistent with those from manufacturers in other countries. And there are only two ways you can get scale as a manufacturer. One is to have a domestic market that's big enough to allow you to do that, which obviously works for the United States and China, and I suppose for Europe as a whole, now that it's a common market. Or alternatively, if you don't have a big domestic market, you can get it through exporting to big markets, which is what, say, Korea and Taiwan have been able to do, what smaller European economies like Switzerland and the Netherlands and Denmark and Sweden are able to do. But the problem in Australia is that not only do we not have a domestic market that's big enough to get scale, but nor are we close enough geographically to achieve scale across a broad range of industries. We can do it in some narrow ones, but across a broad range of industries in sufficient volume to get our fixed costs as a percentage of total costs down to a level that allows manufacturers to be competitive from this base. And the corollary, I suppose, is that manufacturing is a small proportion of Australia's GDP. It's about 6% now, whereas most Western countries, it's between 10 and 20. In Korea and Germany, it's more than 20% of GDP. But another reason for that is that our mining sector at 10% of GDP is 5 times bigger than the average Western countries' mining sector, and our ag sector is about 2 to 3 times bigger as a percentage of GDP than that of every other advanced economy except New Zealand. And the reality, which a lot of politicians seem unable to grasp, is that the sum of the different sectors' shares of GDP can't add up to more than 100%. So if you're going to have a much bigger mining sector and a significantly bigger agricultural sector in Australia than most other sectors, then something else has to be smaller. And it can't really be services because, like most other rich economies, Australians want to spend around 3/4 of their income on services, and most services aren't tradable. You can't import haircuts, for example, and we tend not to go overseas for our own education or for our own healthcare, although I guess in theory and in practice that's possible. We just choose not to do it. So given that most services aren't tradable, if you want an economy that produces things people want to spend their money on, it's roughly 70-75% of the economy is going to be in services, which really only leaves manufacturing as a sector which can be smaller as a percentage of GDP in order to offset the fact that our mining and agricultural sectors are much bigger as a percentage of GDP than they are in other countries. And the only time Australia's ever really had a manufacturing sector that was of a similar size relative to GDP as other industrial countries was during the protectionist era, when we forced Australian consumers to pay unnecessarily high prices for what were often badly made or unreliable goods, simply in order to say that they were made in Australia. And during that period, we went from having the highest per capita incomes in the world, as we did along with New Zealand and Argentina at the time of Federation, to by the late 80s, early 90s, when we finally abandoned that as a policy, we were ranking about 23rd in terms of per capita incomes around the world. So it didn't do us any good. And as soon as Australians were granted the freedom to choose to buy foreign motor vehicles or foreign clothes, that's what they did. And, so as I say, I think there are some manufacturing industries where we can achieve scale and capitalize on some of our competitive advantages, but in the grand scheme of things, they're relatively small. Righty, I think that's probably done it. Can I again thank so many people? I think at one stage, we had a lot of people. I really appreciate you spending the time with us. I hope that's piqued your interest in coming back again, not necessarily for free, and in the other products that we're offering through the website. So thank you. Can I wish all of you who are still here the compliments of the season? If you celebrate Christmas like I do, or Rati does, happy Christmas to you. If you have other things that you celebrate, then the best for those. And we all, I think, hope that 2021 will be a healthier and safer and more prosperous year than 2020 has turned out to be. So best wishes for the new year as well. Thank you, and look forward to seeing you again in 2021.
Absolutely. Thank you, everyone. And thank you, Saul. Have a nice evening.